Okay, great. So yes, hopefully everyone is with me. It has been a long day. And firstly, I'd like to say thank you to Samnet for inviting me to present. Today I'll be discussing actually my PhD proposal that I recently presented to the Stellenbosch University admissions panel. And my supervisors are, of course, Professor Monique Reed and Professor Pierre Siklos. So today I'll mainly be discussing my first chapter proposal. So it is still, the surface that I'm brushing here. So it's still exploratory work. So I will highly appreciate any further comments, suggestions, and I'll try and answer some of your questions to the best of my ability. But hopefully, as time persists and progresses during my PhD career, that I can address these questions. So I'll talk about theory and application of shocks emanating from endogenous or exogenous origin. I'm also going to stop sharing my video because I'm quite worried that I might get stuck because my internet has been a bit sticky. So I'm going to stop my video. So as a quick disclaimer, as was said, I am an economist at the Reserve Bank, but the views that are expressed here are that of only mine and not necessarily that of the Reserve Bank or Reserve Bank policy. So to just give a bit of a quick outline about this presentation, I'll take you through some of the evolution of the theory of shocks that I've come across and some of the authors have come across. And then that will emanate into the information availability behind these events that are considered as shocks. And then lastly, then I'll be taking you through some of the empirical evidence of these shocks and specifically the allocation of time. And then I'm going to touch upon the narrative ex ante and ex post these shocks. So this is quite relevant to what Charles presented in quite a lot of detail this morning. So I'm actually glad he did because I definitely got some pointers there and yeah, it will be good to get some feedback regarding that. So to kick it off with the evolution of shock theory and basically where did it all start? Well, starting off with Slutsky's 1927 paper of the summation of random causes as a source of cyclical processes. He basically explained how he showed how to explain the dampened oscillations of regular fluctuations within a model. And he did this by the moving sums of random series that surprisingly looked like economic time series. So this concept of the random causes kind of evolved into like the discussions of the boom and busts throughout the business cycle theory. And later on in about 1980, Christopher Sims came out with his vector autoregression model and actually interpreted the VAR's innovations as shocks. Furthermore, Cochrane in 2004, in a commentary note to Rober and Romer's monetary policy shock paper, he actually interpreted these shocks that they developed as, in fact, instruments. So there's sometimes this, discussion as to whether these shocks are innovations, how do we interpret them? We look at them as residuals, are they statistical white noise, or do they have economic meaning? And I'll revert back to Bernanke 1986 paper where he refers to the shocks as primitive exogenous forces that are uncorrelated with each other and should be economically meaningful. And I emphasize that aspect that it's economically meaningful. And then, of course, with standard statistics and econometric literature, when we interpret shocks or even residuals, they should be exogenous. They should be uncorrelated, and they should also be unanticipated. The one caveat that, in fact, Valerie Ramy, in her propagation of shocks paper, she highlights that, sometimes in response to an event, there would be a fiscal and a monetary shock that occurred at the same time. And basically her response to that is that indeed these are not shocks, but in fact an endogenous response to the primitive original shock that had occurred at a specific time. So as I was searching through literature and trying to really figure out the foundations of, you know, how do we interpret shocks? What do we look at? I am a modeler. I typically work with models. So normally the natural instinct of a modeler would always look at the residual of a model, assuming that your model is well specified and your equations are well specified. However, digging a bit deeper, I realized that, you know, are the shocks indeed exogenous, and to what extent? And I emphasize shocks and not residuals, because the residuals have to be exogenous. And you know, what are the theories associated to these shocks? Another question that occurred to me is, you know, I cannot tell you the exact timing of certain shocks, specifically to when did it start, when did it crash, and for how long was the recovery, down to the day that, you know, it went back to its original or mean, or however you refer to the, if you want to call it, the long run equilibrium. So there's this timing aspect allocated to these shocks in the buildup of the shock and also after the shock occurred, that I'm quite interested to really dig deeper into. And then thirdly, what are the causes of these shocks? And this was recently my attention that, you know, one thing I could possibly look at is the narrative aspect, again, that Charles brought to attention this morning. And this is quite a neat way to really see what was the information that was publicly available at these times that these shocks occurred ex ante and exposed. Whether it came from policymakers, whether it was from national disaster detection methods, analysts, or people in general. So this kind of led me to branch out a little bit beyond the economic literature and in fact into that of psychology, and why, you know, in the event analysis and information availability. And I came across this Johari window. And in fact, this Johari window is quite a broad concept that, dependent on the analyst or the researcher, they manipulate their understanding of this window to how, whatever their application of the work is. So this has been used in certain risk matrices within the financial literature. I'd like to associate this to the shocks analysis. And, you know, to give a bit of a background of Luft und Income's Johari window that they introduced in 1961 was in the first quadrant, which is the area of free activity. This is basically the information that was publicly available to everyone, to myself and those of the rest of the world. The second quadrant refers to the blind area. So this is the information or knowledge that was available to the rest of the world, but I was not available, I was not aware of it, or I refused to take in that knowledge or information. The bottom two quadrants is actually what I want to emphasize, especially with the shock analysis, if you want to say, or shock theory analysis, is because this shock theory is the knowledge that is available to myself, but myself can represent one person or an institution or a company that has private information that is not publicly available. So this is associated to that hidden area. And then the fourth quadrant, which is the area of the unknown activity. This is purely the information that was not broadly available to the public or majority institutions that could, you know, respond to a shock effectively. So the reason why I introduced you to this Johari window is because, you know, in the event analysis and also shock analysis, Nassim Taleb brought to the world this theory of black swans, and the fact that we can coin these events as a black swan, whether they're positive or negative, to be highly, to be improbable, firstly, but to have massive consequences. And he attributes these to be basically an outlier. It must have an extreme impact, and only ex post, or after it occurred, it is explainable and predictable. So again, this is what I link to the fourth quadrant of the Johari window, where this information was not known, and hence it was highly unpredictable. And because that information wasn't known, and it did have an extreme impact for it to be classified as a shock. So some of the examples that Taleb gave in his further rendition of his book was that of the 9/11, that was considered a black swan event because nobody could have assigned a probability of the 9/11 devastating event to have occurred prior to that. And then also that of the global financial crisis of 2007, 2009. Only after it occurred did some people come across and say, yeah, this was predictable. So on this global financial crisis, Dado Sonnet and a couple of his co-authors in not only his 2009 paper, but preceding papers as well, he kind of contested this black swan event theory, and he kind of coined it as dragon kings, which are also extreme events that do not belong to the same population as other events, but provides clues that allow us to diagnose the maturation of the system towards a crisis. So what does that mean? So similar to that of Taleb's, that, you know, it has to be an outlier. It has to come from a unique origin. It must have a massive impact or spillover effects. And then thirdly, the difference between the Sonnet and Taleb's theory is that this is predictable ex ante before the shock occurred. So overall, Sonnet debunks some of the black swan theory, especially that associated to the financial crises, and reclassifies this as their dragon king. I emphasize Sonnet because I'll touch on some of the methodology that they did to make some of these conclusions a little bit later. So because, you know, Sonnet did assume that, you know, there is some sort of predictable nature preceding a shock or a surprising event that had occurred. And of course, Michelle Wacker from 2016 also wrote a book saying, okay, no, here's grey rhinos, adding to the zoo of terminology. The grey rhino is a highly probable, high impact, but neglected threat. So these are basically early warning signals that were typically ignored prior to a crisis that had occurred. The problem that I face with Wacker is that she says that no, the interaction of these ignored dangers may evolve into the claimed black swan that Nassim Taleb had posed. However, I disagree, and you know, because those black swans aren't predictable ex ante, only ex post where they're predictable. Because it's ex ante predictable, and because there were warnings beforehand, I argue that no, it would have been evolved to be a dragon king instead. But the whole point as to why I'm telling you about these grey rhinos is that, you know, and the point that Michelle Wacker said to her audience is that, you know, grey rhinos are a framework designed to address problems to implement the best and most efficient or correct decisions to prevent or mitigate the crashing or the crisis that's about to occur. So she classifies these kind of early warning signals into four areas. Firstly, that of a charging rhino. And this is basically, you see this rhino coming at you. You don't know whether you go left or right, but you have to make a decision now to move. And I think of this as, you know, in the beginning of the year, we were watching the news and you see how the spreading of the COVID-19 infections were occurring. Started off in China and started emanating through into the US and the Euro area. It hadn't hit South Africa. So we knew that this was going to come to South Africa, but we didn't know how to react. And eventually there was a decision that was made, which is of course then the necessary lockdown implementations and health preventative measures to combat at least some of the pandemic's results. Second is the recurring rhino. So this is a warning that occurs quite often, that regularly is quite familiar to decision makers, not only that of policymakers, but in general, say, corporate governance. Recurring could also resemble that of our unemployment rate. We have our unemployment rate that's fairly sticky, around 25–30%. And it's, you know, where the decisions are made to try prevent that soaring even further, or even mitigating that soaring, you know, it's still very high, and it's a recurring problem that keeps on happening. Third is your meta-rhinos, and this is specifically related to the corporate governance. Say, for example, in a business setup, you have a bunch of decision makers that all grew up from the same neighborhood, attended the same schools, came from similar backgrounds. So their decisions are somewhat biased to the information that they're aware of through, you know, what they were taught. However, by implementing, and this is why then there's this, say, structural factor that is preventing them from implementing the most effective decision to address this meta or grey rhino. And there is theories out there that say, you know, a more diversified group of people can give a broader view in order to make the most appropriate response. And then lastly, which is classified according to Michelle is the most problematic, and which is the unidentified grey rhino. She gives examples of this being that of problems that occur, for example, with robotics. So some may argue that robotics will take away employment, while others may argue it will induce employment. And her whole point is, then why are we even having this discussion in the first place? Why are we wasting time discussing? How do we know that this is even a problem? And this is important because policymakers and decision makers as a whole need to identify these types of grey rhinos in the information that is brought to them in order to make the most necessary, the most efficient and effective responses. But in order to do that, you know, it's important also to figure out what are these kinds of shocks. And it's quite interesting to see, you know, I introduced the concept of the black swans and the dragon kings and the grey rhinos, and there was a reason for that. It's because black swans are saying, you know, that information was not there and it was not predictable, whereas dragon kings are saying the information was there and it was predictable. So I specifically tried to look for information or literature out there that kind of brushed on these topics. Starting with that of Stock and Watson's 2012 paper, when they specifically studied the dynamics of macro variables around the 2007-2009 global financial crisis. And what they basically did is that they looked at using a dynamic factor model. They addressed one of the questions that I found most relevant for this presentation. Is their research question was, what specific economic shocks triggered the recession, and what were the quantitative contributions to the collapse of economic activity? So then they made the conclusion that, you know, well, a number of conclusions, but one of the main conclusions that I want to bring to your attention is that, you know, they found that the shocks that produced the recession were primarily associated to financial disruptions and uncertainty shocks. So what they found is that the monetary policy shocks and fiscal shocks emanated from the foundations of a financial disruption or uncertainty shock that they were able to disclose from this dynamic factor model. On a slightly different econometric nature, Millay and Michel in 2006 actually developed an index of market shocks. Now, going more into the financial disruptions, one would typically look at, you know, let's look at the VIX or anything. So yes, VIX is an alternative, but Millay and Michel particularly are interested with shocks. And what they did is that they developed a measure that heavily that came from geophysics, that is quite equivalent to the Richter scale that is used to determine earthquakes, right? It predicts when an earthquake will happen. So they kind of did this by quantifying the market movements in the equity prices, and they analyzed it on a tick-by-tick scale, where they estimated the volatilities at different time frequencies, did a weighted average of this through a principal component analysis, and then developed this index of market shocks. I am heavily oversimplifying this paper, but if you are interested, you're more than welcome to read more into it. And then lastly, I'm going to bring you back to Sonay et al. And the reason why I'm doing this is because this is the foundation of where I want to implement my, my PhD on for this chapter, is that Sonay, what they did is that they assessed the equity prices, and they applied a wavelet filter. Now, a wavelet filter is common within geophysics, but also in financial literature, for those that aren't aware of it. And what this filter does is that it actually isolates the statistical white noise from the residual, so that that residual can actually represent economic meaning, and i.e. the shock. So, and then what they do is that they apply, and this is their novel introduction to literature, is that they apply this log periodic power law signature, which is their main contribution to literature. Basically what they do is that they have this prior analysis of outliers that they determined from this wavelet filter, and they show a distinct structure of price trajectories that actually exist. So what does this mean? They basically see this, they determine this buildup of past residuals that determine the speculative bubble of endogenous origin. So what they do is they find these outliers, and this is the event that a shock had occurred, right? Where there was this buildup before it happened, they coin this as a speculative bubble. There is some caveats as to how we interpret this bubble, because, you know, in standard business cycle theory, a bubble is typically the price deviations away from your fundamental price value. So this, you know, it needs a bit of further analysis as to why they classify these as bubbles. But what was quite interesting for me is that at least it's showing and it's studying the residuals itself, and not necessarily the parameters that some other, say, breakpoint econometric techniques use. So, and I'll give you an example with some of these literatures do, and where I'm going, well, where I'm getting at for what I'm pitching. And basically, that of Malay and Michel, they showed this time stamps, if you want to say, about when these respective crises started and when these crises ended. But also they provided the magnitude as to how large it is. Whether it's respect to its mean or not, you can actually see how big of a shock is it relative to the previous shocks that we've seen. And then lastly, for how long did it go on for? Likewise, that with Sonay, they took it a step further and actually disentangled these shocks a little bit further into whether these shocks emanated from exogenous origin. So was there this buildup in the residuals prior to this event that they isolated within the outliers or not? So this is why they classify the bubble, which is basically the shock that came from endogenous origin. And then where you see the shock, that's the exogenous origin. And then the duration of that and the respective size of that as well. So, you know, what does this mean? So what I want to do, and hopefully I'll show you as time persists, is that I want to analyze these risky assets, whether exchange rates or bond yields, and leaning more towards the bond yields. And I want to follow the similar methodology to Sonay et al. I think it's a new perspective to analyze shocks from a residual point of view, as well as, you know, they do use alternative specifications for the wavelet filters, but also I'd also like to kind of test that with alternative filters as well. to kind of cross-correlate those events that it picked up these certain outliers and the build-up of the residuals with respect to that log periodic power law signatures. And lastly, what this will do is that I will be able to, one, determine events that had emanated from endogenous or exogenous origin, and kind of isolate the time that it started, how long it occurred, and also the recovery period as well. So that's the one interesting aspect that I think that we can explore, especially for South Africa's case. And then second, which is a recent phenomenon that was brought to me, is that, but what is the causes of these shocks? If it did display endogenous behavior or emanate from an endogenous origin. And this is where I'd like to explore the narrative behind these shocks. So very similar to Charles, and actually I decided not to go into much detail here because he went into quite a bit of detail earlier this morning, so it's fantastic. So basically what I want to do is just basically extract the titles and the first paragraphs from Google News associated to those time allocations that I would hopefully derive using the methodology of Sonnet, and then kind of pick up what were the topical issues that were provided for ex ante that shock, but also exposed, and then to see how that narrative kind of changed in a sense. But what I'm suspecting is that exposed, and typical with Nassim Taleb's Swan theory and the public information that's publicly available only after the shock had occurred, would we kind of start figuring out what were the reasons of those shocks. And this is important also for future analysis, for any forecasting work as well, is that, if you start seeing this buildup of residuals that reaches a certain point, it may be an early warning signal of, say, a particular type of a grey rhino that might kind of create this awareness for the necessary policymaker or decision makers to implement the correct decisions or most efficient decisions to be made. So at the end of the day, what I'm hoping to do is to address some of the questions that I originally asked were, are these shocks truly exogenous and to what extent? And funny enough, I came across a paper by Kuhn and Borusiak, that was released in September 2020. But using panel data, they basically were able to leverage exogenous shocks into counterfactual shocks. So what I understood from that paper is that they were able to isolate kind of this instrument from the residual, where your residual is left as your statistical white noise, and it is true to its statistical nature that it's supposed to be exogenous and uncorrelated and anticipated. But then there's this other element that you've now isolated, which is the economic meaning and may exhibit some sort of endogeneity behavior. Sonnet alludes to the fact that some of this endogeneity behavior might be some herding behavior within the financial markets, but that's something that I explore in my second chapter. And then, and then basically the time elements as to when they start and end and for how long. And then lastly, through the narrative, what are the causes and of these shocks relative to the publicly made information that was available. Thank you. And if there's any questions or suggestions, like I said, I'd really appreciate it. This is I'm still in this exploratory phase, so I may not be able to answer some of the questions, but I'll try my best. Thanks.
Thank you. Yeah, I think you're definitely on an exciting track ahead, and you've done some extensive research. Are there any comments from anyone in the panel?
Maybe start. I'll always start.
We need to know your recipe of espresso.
Yeah, that's true. I should. Thank you, Laura. A few things. One, it is this concept of exogenous and endogenous shock. What are you going to do? Where you derive the shock from? Therefore, you are taking, let's say, a time series of financial variables. Generally, when we think about shock, we have some structure, and then what is exogenous or what is a residual of that. We name as shock essentially because, like a lot of the work of Amin Nakamura is very much, there is a lot of identification problem. What we cannot identify, a lot of time we call it shock. Now, how does now this decomposition with exogenous endogenous shock is going to work? Therefore, is the endogenous the bubble that comes from an exogenous shock, or endogenous is something that would have been predictable if the model, if you want, was identified correctly? I don't know if I am clear on this.
Yes, you are clear. So maybe I wasn't clear. So when I emphasized the outliers that were detected, typically one would expect that is the shock, right? So there is prior analysis to that outlier, whether there was a build up to this outlier, which you correctly assumed is the speculative bubble that the authors do coin, as this outlier had emanated from endogenous origin because there was this kind of build up through this log periodic power law that they were able to pick up. If this did not exist, that means that that outlier originated purely from exogenous foundations. So hopefully that's a bit clear. So I'd like to kind of apply similar methodology to that of financial time series. I'm still in between doing it across a variety of time series, but at the moment I'll start off with one, which would probably be the bond markets, and then resonate forward, just as a cross correlation check as well. Hopefully that's a bit clear.
Yeah, absolutely. But then the narrative, you really are looking at the narrative before, before the shock. In the sense, I have the impression that it becomes an identification problem in the sense that, what we call shocks, actually they are not shocks. To identify this endogenous process, because if I identify endogenous process, then I have an early warning system on the shock. And the narrative, because we all know that we have very good narrative ex post. I can tell you a million of stories ex post, but the problem is what kind of narrative ex ante is a good predictor of the shock. Therefore, what kind of structure I had before? Am I correct? That's where you want to go.
Yes, exactly. So the last point is to what is driving this build up ex ante to the outlier. And in fact, Sonnet alluded to the herding behavior aspect, but it's something that I'd like to explore through textual analysis from the narrative approach, to see through the information that was publicly available that would typically be the foundation of some of the moves within market traders, as to the buildup of this, say, bubble. And I'm literally quoting this because it is dependent on how you interpret the bubble. But yeah, so that's basically what I'm alluding to exploring.
Nice, thank you.
Okay, we do have a recommendation from Charles, who presented this morning, and he says that he recommends Robert Schiller's book on narrative economics. I don't know if you've come across that. He says it talks a lot about exogenous and endogenous shocks and what is predictable. And so if you haven't come across that, it should certainly be useful. We trust his views.
Thank you. Yes, I'll definitely look into that. Thanks.
Cool, thank you. Are there any more questions from anyone any recommendations? Yep, not yet. Well, thank you very much, Lauren, and good luck with the rest of the research. I'm sure it will definitely, it'll definitely be valuable in the long run, and great contribution. Thank you.
Thank you everyone for the suggestions and commentary, and yeah, good luck with the times ahead.
Cool.
Bye.
Thank you.